the closing beat, everybody. Happy Monday. How'd you do over the weekend there? A long weekend. Hope you had a great Thanksgiving. Everything went well there and you are refreshed, back to your diet, feeling good. Thanksgiving for me is like, I feel bad, I eat bad, and then I just sleep for a while, and then I'm like, let's get back to work. All right, let's do this. Hey, this is the Closing Beats, a quick show that we do for our customers here at Jazz Wealth, but we also do it publicly for you guys as well. We do classes and stuff for all of our customers. We're a teaching advisor, so we don't just like to invest and then like sit back and call you once a year or something. We like to hit you every week, give you something new. We're also doing weekly emails out to our customers as well. I did test that and sent it out to a few other people on our email list just to see if that's something we may explore doing for people. I get kind of specific in there, so I don't know that I'm actually allowed to send that to anybody unless they're customers. But hey, hope you'll check us out at Jazz Wealth. I really appreciate people just even looking into us. I know it's small fish, big pond. I say that all the time. But we're SEC registered fiduciary advisors. We're just trying to do the right thing for customers, but also teach them along the way. So I'm a big fan of teaching how things work. So I just try not to leave anything out. I think you guys get that based on our show here. Hey, we're also playing a game. It's called Guess the Dow. You can go to jazzwealth.com/guess the Dow. And if you're the closest without going over, we'll send you a $100 gift card if you're not a customer. We'll credit your account $100 if you are a customer. And our winner from Friday, which we weren't here, so we didn't get a chance to announce it. Our winner is Bill Bruning. He was the closest. We've already sent an email. He's not a customer, so we're waiting for his address so we could send him the $100 gift card. Bill's guess was 28039.51. The Dow closed on Friday. It was a half a day at 28051.41. So very close there. Congratulations, Bill. Our guesses for this week are closed, so if you've already made your guess, we have those submissions ready to go. We'll announce the winner on Friday. But if you want to guess for next week, just go to that website, the bottom right-hand corner of your page. Okay, that's all the homework I have. Let's get started. So the Dow pulled back finally. You notice how Friday we pulled back? I sent out an email to customers to let them know, hey, you guys have been shopping. The market's pulled back. We've all been wanting the markets to pull back. And we finally got it. You got the Dow lower by 268. And let's take a look at the S&P here. Finally, a pullback. Now, this is 35 days where we still within a range of plus or minus 1%. So this was very close to falling 1% today. After hours, you could make the argument that it officially did break the 1% mark, but we're not using that stat. So we got a little pullback off of highs today. Basically, you had some Trump tariff comments on Argentina and Brazil, I believe, since he was felt pretty strongly about them manipulating their currency. We're putting tariffs on all the imports of steel from Brazil and Argentina, I believe is what it was. Brazil and Argentina. Yeah. So you got that. You also had manufacturing numbers that came in a little bit weak, so the S&P pulling back here, but still very much in an uptrend. It's obviously had a great move since it broke to new highs. Let's just hope, I'm with you guys. I mean, I know as a financial advisor to want the markets go lower, you're sort of asking for customers to panic and everything, but our customers are a whole different animal over here. We're all cheering for the markets to be lower so we can get a discount here finally. So we'll see. Also in the email this weekend, we talked about the statistics of there being a 10% pullback, where we land on that and how to prepare for that and everything as well. Most of the action today was actually early. We'll go over here to the 5-minute chart. I won't take too much of your time today, but you could see 9:30 stock market opens, and a lot of that action came from the morning tariff comments and then the manufacturing numbers that came out. That sort of pushed us to lows. And then that was it. I mean, pretty much the rest of the day we chopped around, tried to bounce a few times, but ultimately finished on lows. Not a good sign if you're a bull. That sort of hints at more downside to come, which is fine. We've got this technical support area, which I've left there, just the prior highs. That's when we broke out to new record highs. That'll be around 30.25, let's call it. And so for the markets to pull back sort of cautiously towards that area would be okay. What you don't want to see is one of these over here. Most people don't like these types of drops where you sort of fall out of bed. So hopefully we don't have that. But that's the S&P 500. If you take a look at the NASDAQ, we also pulled back today. Investors came after tech stocks today, one of the more overvalued areas of the market. That's the NASDAQ. And the Dow basically performing the same as far as pulling back, which is all seems to be very welcome by most people here. And so that's where we stand as far as that goes. For November, had a 3.6% gain in the S&P 500. That's the best month since July of this year. It's actually the best November since Trump took office in November 2016. So gives you an idea where we're coming from. You can see on the charts there. We did very well for the month of November, and we're already starting to pull back. Not too big of a deal there. Manufacturing numbers came in weaker than expected. Let's see if I can show this here. It might be a little bit messed up. No, it looks pretty good. Okay. Here's the manufacturing numbers. We don't put a lot of emphasis on manufacturing numbers anymore. That's why you didn't see the market sort of panic too much today, because we're a services economy. I've mentioned this every single announcement for the last 3 announcements. You've got manufacturing numbers come out on Monday. That was today. They did tick lower a little bit. If you dig into the manufacturing numbers, if you like really geeking out on this stuff, you're going to find that 6 out of the 10 categories that we break down inside of manufacturing, orders and inventories, things like that, they came in negative. So that's showing a little bit more weakness than we were sort of expecting versus just saying, oh, it was a slight downtick. In this case, it was a slight downtick, but the underlying sort of combination of what makes up the manufacturing numbers didn't come in very good there. It's been trending lower since the sort of middle to end of last year there. If we can zoom out, well, let's go all the way out here and just put in the recession so we can show you here. Manufacturing numbers do trend lower ahead of recessions, as you would probably expect. Here's the last recession. We were already trending lower into the recession. The one before that, the one before that, the one before that. The recessions are the gray shaded areas behind you there. So the fact that we're trending lower is not a great sign, but what's been saving us here is the non-manufacturing numbers. No, we got to do it like this. U.S. Holy cow. You know, you got to be prepared for this sort of thing. Okay. U.S. non-manufacturing. There we go. Come on, buddy. Hang in there. So if we take this out here, we're going to back out the manufacturing numbers for just a second. We'll go to services. So the services numbers have largely been helping us out. We've been getting manufacturing numbers coming in weak, services coming in a little bit stronger. They did downtick 2 reports ago, but overall that's been helping support us. We'll get those numbers on Wednesday. As long as those stay relatively in the same range there, I think you find that people are kind of discounting what happened today as far as the overall manufacturing numbers. And that's just because we're services oriented, right? Our economy here is based on the service, not necessarily what we make, although Trump would like to change that and maybe is working on that. But so that's what you have there. Some of the reason for the early weakness in the overall stock market. Let's do our sector breakdown here. We'll go back to the charts. There you go. We mentioned tech stock. Oh, come on. Tech stocks getting hit pretty good here today. Here's the XLK. I'm going to bring this down a little because I know you guys like to see the ticker, and that somehow got off the screen. That's your top left corner. XLK is what we're looking at here. Biggest range in over a month. You actually got to go back all the way to October 22nd to find a down day or even an up day that was of a bigger range from high to low than we've seen here. So that gives you a good hint at maybe the start of a pullback. Some of the bulk of what would cause this today was Microsoft. Down about 1.25%. That's been really strong here lately. Apple also, these are 2 big stocks that have made a lot of headlines lately because of their valuations. Apple down about 1.1% on the day. Those 2 names, Microsoft and Apple, make up about 40% of the tech sector there, the XLK. And if we go a little bit further, you look at some of the other fintechy sort of stocks. Visa was down today 1.5% and MasterCard down about 2% on the day. Those 2 together make up another 10%, so you got about 50% of the tech stocks just all in 4 names there. When they're weak, you can imagine the sector is going to be weak as well. We've got some choppy technical patterns out there. I started to mention this last week on the REITs. You didn't like to see REITs bounce where they did. Reason for that is, if you take a look at what happened, you had a pullback off of highs. Everybody was excited because they finally got the pullback. You even thought you had the bottom there for a little bit, so anybody that bought that dip was pretty excited. And then this pullback right in here makes you a little nervous, right? So those technical traders that wanted the pullback and paid for it, not so exciting there. Those that felt like they missed that pullback did get a chance to dive in. But now that you have this back and forth, you have sort of a new developing trend, and it's too early to say if it's a downtrend. It's also too early to say if the uptrend is going to resume itself here. So for that reason, in the REIT space right now, you kind of have a recipe for a choppy sector for the rest of the year, unless that just gets resolved here in the next couple of days. What you want to see is a really aggressive pullback under the 200-day moving average, which is the red line there. That'll make people feel like, okay, there's still room for a discount that will give more way to those people that have been hanging on up here and haven't taken their profits yet. That will cause them to take their profits. It will also give a reason for people to sit and hunt for the next support area in REITs. If we happen to reverse course and start heading higher there, you get the FOMO people, fear of missing out. They thought they were going to get the drop. They didn't get it, and that's it. Anything in between these highs and these recent lows here, about the 200-day moving average, you have no reason to convince people to dive in because they're going to miss out or feel like they're going to miss out. You also have no reason for people to sell if they've been holding a very profitable area of the market for this entire year. So choppy pattern there. Also choppy patterns in the home builders, still very much in an uptrend, just chopping back and forth. Again, you have no reason to get people to now want to dive in, but you also have no reason to get people to want to sell. And so that's one of the sort of weird areas of the market. And I'll also go as far as saying materials. Same thing, right? You're coming out of an uptrend here, but it's early. So you have people saying, I don't know if I want to buy yet. Let me see if it pulls back more. You have people that have owned this sector or maybe are trying to rebalance into the end of the year saying, let me hold off and see if I even need to do this. So these are some of the areas, unfortunately, that are just a little bit weird for the moment. We'll keep following up with them to show you. Moving on to healthcare, we've got about a 0.5% pullback here. Nobody seems to mind. These have had a great run. There's actually a great chart floating around. I believe it was JP Morgan. We get all the reports that these guys put out to their high net worth customers, and when I can, I share them with our customers because it's just not fair, right? If you're a multimillionaire and you're getting different research than someone who's younger and maybe just getting started to invest or a retiree or something, I don't think that's very fair. I think it was JP Morgan. It could have been Bank of America. Nonetheless, credit to both of them if that's who it came from. But what they did was they did a study to show Elizabeth Warren, her sort of decline in the polls. As they've declined, if she's declined, healthcare stocks have gone up in almost a 1-for-1 correlation there. So healthcare, nonetheless, got a little overextended, maybe a little ahead of itself, and starting to pull back just a little bit there as well. Looking elsewhere around the different sectors, oil was a little higher today. Expect volatility here. You had OPEC today, Saudi Arabia came out today and said, look, we want OPEC as a group. We want them to continue the production cuts through the summertime, I believe, through the end of the summertime. But they don't meet until Friday this week. So all week you're going to be hearing from the different nations that make up OPEC, and there may be a little tug of war there, so expect some volatility. You also have crude oil inventory numbers coming out in the States here it'll still be Wednesday this year, actually, or this week. So oil a little bit higher today, but I don't think you've seen the end of the volatility there. If we take a look at bonds, we'll look at bonds directly here. Big drop in bonds today, meaning yields went higher overall. Got a sharp move there. There was a report that came out. The Fed sort of put this out there. Very smart by the Fed. These are no dummies here. The Fed basically leaked a report to the Financial Times or somebody that said, we were shooting for 2% inflation, but we might even allow the economy to run at a positive or over 2% inflation for a while before we do anything with rates. Well, that gives people reason to say, okay, here we go. We don't need any bonds in here. And so the price of bonds moving a little bit lower. On the screen coming up here, you see the long bond, which would be the 30-year. We'll go over to the shorter term. 10-year, you also saw a pretty good spike down on the news of that this morning. Also want to point out the VIX volatility. I know a lot of people like looking at volatility, using that as a hedge, or maybe even trading that more aggressively. 5% spike in volatility today on the pullback. That'd be its biggest spike here in months, right? So just coming off the bottom a little bit, it looks like, as the market tries to pull back. Careful on these. If you're going to play volatility ETFs, I beg you, please understand how they work. These are short-term trading or short-term hedging vehicles. These are not investments. These are not midterm sort of strategy plays there. Just be very careful. Okay? There you go. Brought to you by the letter J for Jazz. Amazon, a little lower today, down 1%. You got this holiday volatility thing going on here. It made us wonder. You have Cyber Monday, and so the question was, does Amazon usually sell off on Cyber Mondays, or is it something else under the surface here that we're looking at for Amazon? So we went back 21 years to 1997, and we found that the worst year was in 2001. It lost 7%. In 2008, it lost 5.5%, but the average Cyber Monday performance for Amazon is actually positive by 0.4%. So it's kind of a wash, basically. Cyber Monday can be a hit or miss for them. You have people maybe taking profits into the news, but that's sort of a tough argument this year given what's happened there. But typically quite positive, or positive by about 0.5%. Median gain of 0.65% there. We were reading through some of the analyst reports here for Amazon to kind of see why isn't anybody excited about where it's at, the possibilities, everything going forward, the Prime one-day shipping and everything. What's going on there? A lot of the analysts feel like the expectations going forward for Amazon are way too high and that those are going to come down. That's just a fancy way of saying analysts have looked at the stock and as a whole they believe they expect this. And a lot of the analysts are starting to say, you know what, we're probably going to be around here, but nobody's adjusting their targets yet. As they adjust those targets down, which is a prediction on their part, they feel like that's going to hurt the stock in the short term. So I'm just speaking on behalf of what I read. That is obviously not my belief or comments, so please don't act on that in any way and get me in trouble. You got Roku down 15% on the day today. Quite an aggressive sell-off. And if you look at the chart, it did stop right at this uptrend line. All right, basically right there. Stick. There you go. So you got Roku pulling back to a really short-term and very sloppy uptrend here. You don't like to see that kind of volatility if you're an investor in the stock. Morgan Stanley downgraded the stock. They said their revenue and gross profit will likely slow down in 2020. You guys might, I mean, if you have been in Roku, you know they've just been killing it. Revenues and overall gross profits have been high and climbing. Morgan Stanley just says, look, we don't think that's going to continue into 2020. Now, the difference here, they downgraded the stock, but they raised their price target. So they were at a $100 price target. They downgraded it and said, you know what, 110 is more of a fair number. They're not expecting the end of the world for Roku, which would be silly if they did. They're basically just saying, we think estimates are a little high here for what Roku can do in 2020. So for the next 12 months, they have a price, as of now, they have a price target of $110. We'll see. I think if it breaks this short-term trend line, I think you've now found a stock that just will find no real direction. It'll be choppy. It'll be volatile on the news and everything. But for now, still in the uptrend, just a little bit more sloppy than you'd like to see. Let's go briefly through the pot stocks. You got Aurora Cannabis and Canopy. There it is. Down a little bit lower today. I only want to point this out to say if this were any stock, any sector, any market that had downtrended this much and rallied off the lows as aggressively as they did 2 weeks ago, that's great. I mean, if you're investing in it, it's good news. But what happens is the longer it chops around here at lows and does not start a new uptrend as everybody's expecting, then what happens is people start to give up. Imagine the emotion of investing in something that's falling. You already had to go out on a limb and assume that that was going to bounce based on what you read or what you found. If some time passes, called a time stop, a lot of people use these in their trading. If some time passes and you've invested in the stock and you've yet to see a gain, you really haven't seen any loss or anything, you're just sort of floating around, you lose interest and go, well, wait a minute, everybody else is making money over here. Maybe I'll just take some of my money and put it over there. So that tends to have a little downward pressure on pots or on stocks in general. In this case, I'm pointing to the pot stocks to show you kind of what's happened there. So hopefully that helps you. A little more analysis on those stocks. John Deere, a little bit lower on the day, 1.6%. Remember, they missed on expectations, earnings, sales growth, and everything. We covered that last week for you, early last week. They were lower, got downgraded today. I believe it was Bank of America downgraded them following that disappointing earnings. So that was just their first chance to reanalyze, tell you what they think, and they downgraded the stock. Looks like it's headed back towards the 200-day moving average. Wells Fargo downgraded today, down 1.5%. This was on Raymond James. Raymond James is a local competitor of ours, although I don't think they'd see it that way. They're right down the road here. So Raymond James, a great analyst, by the way. I won't say anything bad about them. But they downgraded Wells Fargo, and they said Wells Fargo's revenue has been shrinking, I believe, the last 5 years. And they're predicting that next year it will shrink again, which means that would be 6 years in a row of declining revenues for Wells Fargo. And so they say because of that, of their expectations, the stock is just a little overpriced here. And so the stock was a little lower today. 66% of the S&P 500 is above the 50-day moving average. That's down from 73% last week, so a bit of a pullback there, which you can imagine. You see the market's pulling back. That's okay. You had 16 new 52-week highs today, and all but 3 of those finished in the red. Bank of America was one of those that did finish positive with just a tiny gain. Yeah, 1/3% on that one. But it hit new 52-week highs and basically gave up everything for the day. 13 names in total finished lower on the day. Apple was the biggest loser, down 1.1%, and that's it. That's as bad as it got. Apple was actually the only stock in the new 52-week highs today that lost more than 1%. Most of the losses were in that 0.5% to 0.8% range in there. You had 2 new 52-week lows today. One of them was sort of nasty. Apache down 12%, making new 52-week lows. Of course, the volume way above average. You can see the gray spike in the background there. That's the volume overall. They had some disappointing results from a new well that they're digging or a new area that they're exploring. Basically, they dug down to like 6,200 feet. They didn't say it didn't go well, but the way they reported it was to say, we went down 6,200 feet, we're going to go to 6,900 feet. That's kind of a their sneaky way of saying we didn't find what we were looking for, so we're going to try to dig a little deeper, and that's not good news because that was an expensive one. If you want to read into that, that was an expensive location they're building. I can't pronounce where they're at, so I wouldn't be able to tell you. Okay, so that's that. Here's some stats for you. I'll give you an interesting stat. Over the last 10 years, so if you take the last 10 years of the S&P 500 and you compare that to every 10-year period going back to its inception, the average return is average gain is 10.4% a year, which is good news. Even better news, the S&P is currently averaging 13.4% a year for the last 10 years, which means we're above average. Markets like to be around averages, whether it's a stock and it gets too far from that 20-period moving average or 50, and I'll point that out to you guys, or whether it's performance-wise. People know this. They look up these results. This is something that is a known event. And so total return, from a total return standpoint, we are above average, and so to expect a 3% pullback at least in here would be very, very normal, at least for this year. I don't know if that helps you or not, but it's just one of those things that kind of shows over the last 1 year, 2 years, 5 years, and 10 years, the market is actually trading above average relative to where it does historically over since 1928, the very, very beginning of the S&P. So another indication that if a pullback came, it would be basically welcome. People are sort of expecting that. Like I said, I also did a note out to customers going over the stats on the 10% pullback probabilities, where we stand at the moment, to try to get your mind wrapped around that. So that's that one there. I would say, well, let's do a couple other things here. You've got Schlumberger, ticker symbol SLB, paying out 50 cents in dividends, and DXC is paying, is that the right one? DXC Tech, yep, they're paying out 21 cents, all looking good there. Now, in the S&P 500, you got a little bit more jiggling around a little bit thanks to a merger. Viacom, symbol VIA, will be taken out of the S&P 500 in just 3 days, and it will be replaced by Berkeley. Well, I just call it Berkeley. What are they really called? Berkeley WR Corp. So WRB will be taking the place of Viacom in the S&P 500 on December 5th. So you got 3 days left to go. A little jiggling around in the S&P 600, but we don't need to cover that, I guess. And so that's what you have there. Now, I want you to watch something. I'll take your questions here in just a second, but I want you to watch something very carefully. When the markets are doing well, you notice the tone in the media. The headlines you see, the people that they bring on to talk and everything, all great people, nothing bad about them. But watch the tone change if the markets do not recover from these lows, or this recent low today, and start bouncing from here. You'll see the tone change more into trade tariff delays and China maybe not going to sign this or that. If that happens, it becomes more prominent. China's already saying that. They were saying that all weekend. That, hey, look, if you don't get rid of some of the existing tariffs, we're not signing phase one. That's baked in. We already knew all that. You'll see news about a global slowdown. All of a sudden, the manufacturing numbers from today will become more magnified. You'll see holiday shopping news, things like that. You'll see the word recession thrown out there more. It's just because of where the markets are moving. So we'll allow it, right? I think everybody here wants a pullback. So we'll allow those comments, but really watch how the news, the narrative just changes, which all of a sudden makes you a little bit more concerned, right? If they would just stop the news right now and the markets fell, you probably would just go about your life, right? No big deal. So just be very careful of that. It can be a little interesting. I love watching it, but it could be a little bit interesting if you happen to be tuning in and checking it out. I'll try to keep you posted on that. Do you think UTX is a good buy? So United Technologies and some of the defensive names pulling back here as well today. UTX lost 2.25%. That's 1 day down, right? Always, here's a little rule of thumb that I'm pretty sure I can't get in trouble for saying. If a stock has one bad down day, never be the first to sign up to buy that after just one big wide range day like you've seen here. Same thing over here. The first big wide range day, you don't have to rush to buy the stock. Look, you got more days. They start pulling back as well. Big wide range day down. Look, you get more down days, okay? So really keep that in mind. When that happens to the downside. You've got UTX giving you a really big down day here. You would expect, and maybe you put it on a watch list, you know, and you sit back and wait and go, well, I like the idea of buying some of these names, but let me see if I can get them cheaper. Highly probable that you will be able to get them cheaper. So I would be careful there. Cool. Should you invest a little more heavily in steel stocks after the steel tariffs? I wouldn't use news like that to do anything other than short-term trading. So if you like playing the volatility of news events, those are your short-term traders. Investors, you can be a little more careful there because you don't want to end up, I got a lot of questions on this over the weekend, you don't want to end up too heavy in one category because you see a narrative changing. Your goal is to invest for your goal. If you're long-term, you're investing for your goal, and there'll be little adjustments along the way, but no major shifts in where you allocate your dollars, hopefully, right? So short-term traders, yeah, you could look at that and say, okay, volatility is going to be over there for a while. You expect to hear a little more in that in the headlines. You could probably have some fun there. Long-term, I think it's maybe something you want to consider. Shadow says, how tough is the CFP exam? Can someone of average intelligence pass it? Yeah. Yeah, you sure can. We're not certified financial planners here for one reason. Number one, we just offer that to all of our customers anyways, and there's no rule that says we can't do that. Number two, to be a CFP or to want that designation, you actually have to offer those services or say, I'm going to have a business where I say for $2,000, I will do financial planning for you. I just don't agree with that. I just think that any advisor should also offer that. With the tools and technology that's out there, they should just offer it, and which is why you don't actually see anything on our website that says for $2,000 or $1,000 or $5,000, we'll create a plan for you. We just do it for all of our customers. We actually give them the software to do that as well, so we can do it together. We're going to work on things together versus having it be a one-time thing. It's less money for us, but hey, it gets it dialed in, and if it gets you asking questions, that's it. I had a customer ask me the other day, why don't you just do the plan for us? I don't want to use the software. And so the answer to that was because you're already asking questions. Because if you go in there and go, Dustin, where do I put my pension? Dustin, how do we account for taxes? Those are questions that you don't get to ask an advisor. And by asking those questions, it gives me a chance to say, well, let's talk about where you add your taxes, but also, how are we going to figure that out? Let's talk about you more in particular there. And I love that, right? Because it gets you that much more dialed in. But could you pass it? Yeah. CFP to me, I think the Series 7 is the hardest out of all of them. I took that one and passed it. I got 86, by the way, if you guys want to look it up. I was pretty proud of that. That was a very tough one to take, but yeah, you could do it. How come when oil is up, the XOP stays flat or just a little bit high? So the oil and energy names that are in that ETF are smaller. There's a lot of them that are more weighted towards the smaller cap side of things, and those have been really weak. They've gotten a little bit of a bid lately, but not enough to lift that sector. So I understand maybe the frustration there to try to get that XOP to bounce. You would feel like they're going to start kicking in here soon, but they haven't so far. What do you think about using one ETF versus another? So obviously we're talking two different, when you use VUG versus the SPY or VOO, you got two different scenarios there. So I wouldn't limit yourself to just one if you have to. I would try to pit them together and say, well, what do I get if I end up allocating 20% here and 40% here and then the rest here or whatever? What do you get? Personally, I'm a little bit more of a fan for the younger investor. If you're going to use any of the index ETFs, I like the SPY. It has a thicker options market, and you may not even consider that now, but if you're building a position in one ETF for the long run, you're really going to like that when you get older and want to use some of that for income. So I think there's like a 0.1% expense ratio difference, not even, I think it's 0.8% to choose the SPY. So personally, I would focus more on that. If I could only build a position in one of those three that you suggested, that would be it. Do dividends get taxed at a lower rate after 1 year of owning the stock? Dividends are not paid out in that fashion. So if dividends were paid out once a year, no, even still it wouldn't fit. But dividends are paid out as the company pays it out. You actually don't get to control that. So therefore, most of the time, it counts as ordinary income. If it's a qualified dividend, then you can get that short-term tax capital gains rate. That'd be like preferred stocks or some of the known qualified dividend companies, some of the REITs and things. And it's all accounted for on your 1099s or your statements there. Yep. So you're allowed to be a financial advisor without, are you allowed to be a financial advisor without having that, without having the CFP? Yeah, you sure are. The SEC actually, so there's a new form that we have to now offer to every customer as well. The SEC is trying to really set the distinction. What is a broker? What is a planner? and what is an advisor? Because it's really confusing how they do it in the industry right now. An advisor is not technically a planner. A planner is not really an advisor and may not even be able to invest for you. And a broker is sort of fading away. Those are the people that are sort of hybrid. They can invest for you. They can sell stuff to you. They can do some planning for you and stuff. They're really trying hard. The SEC is really trying hard to do that. And because we're SEC registered, we now have to fill out another form, which we just finished today. So, Joy, more forms. But I do agree with what they're doing because there's a lot of confusion wrapped around that, and they're trying to fix that. But you absolutely can. A lot of financial advisors are not CFPs. CFPs tend to just stand on their own and focus more on planning for that. Yeah. Kevin says he wants to buy he wants to buy a whole lot of Starbucks there. Well, you can't argue that you had a discount there. It's been underperforming the markets, so you have relative weakness overall, kind of hovering around the 200-day moving average. The markets for the last month have been trending higher. Starbucks has not, which has to make you think, if the markets start to pull back, why should there be any strength in something that wasn't even strong to begin with? So for that reason, I would assume that I could find a better price. I would argue that maybe it's more of a scaling in type thing. Maybe you could scale in a little bit, average down if you do get that pullback. I just don't see any reason to say, that's behaving as it should at the moment. Yeah. Cool. Well, I'm glad you guys made it back here after the holidays. I think we've covered everything there. And I appreciate you guys watching and the questions too. I always tell people there's no question I won't answer, even if you don't like the answer. I don't mind. You can ask anything, and so I appreciate the questions there. Always helps with the transparency. And in the meantime, I will wish you a great rest of your day. Thanks for watching, and enjoy. See you later.
Hey, wait! Before you go watch one of our other great videos, have you had a chance to see our new FinTips videos? They focus on one topic at a time, covering investing, personal finance, and anything that can quickly help you with your dough. Best of all, we'll keep it real short, because we know time is money.
Why should you choose Jazz Wealth as your retirement or long-term investing service? Our portfolios are managed by us, not some faceless mutual fund manager. Our private classes will teach you everything about investing and getting your dough straight. Best of all, our fiduciary standard means your best interest comes before ours.